Good morning, everybody. This is Don Pren with InsMark. Really happy everybody could join today. This is the InsMark Sales Idea webinar series with Chris Jacob, and this is the third in our series. I personally believe what you're going to see today is one of the most significant developments for financial advisors in my lifetime. And that's a big claim. And I think today, over the next hour, you're going to see why I feel that way and why you might agree with me. I would also like to tell you we've had the largest number of people register for this webinar in the history of InsMark. We have 450 people registered for today's event. And just as an aside, this is the third in our series of this webinar, and we're trying to create sort of the industry's first monthly podcast webinar series to share ideas and help financial advisors be more successful. So if there's anyone or any group that you feel would benefit from attending, drop us a line. Tell us how to get in touch with them so we can invite them for future episodes. What you're going to see today is a very unique home equity product that is different than sort of the HELOCs and the reverse mortgages and the shared appreciation contracts existing in the market. Essentially, what they're doing is they're doing a fractional forward sale from someone's residential property, and they're advancing money for that fractional ownership from the homeowner. That then creates liquidity that can then be repositioned into financial instruments that can then possibly improve the client's income, cash flow, and so on. And maybe it's either better or worse, right? So what I want to show you just as a framework today, so you kind of know what we're talking about, we've been spending the last month or so integrating, and this home equity product that's a fractional sale of someone's personal residence to the cornerstone company. What you have is we've been integrating that home equity product into our Wealthy and Wise advanced software platform. What you're going to see today is we build scenario number one, like we always do with Wealthy and Wise, which is we build a financial plan for the client from their current age out to age 100, age 95, or whatever you want to do. And we assume a retirement year, and we look at their assets and liabilities, and we estimate Social Security, and then we build a Wealthy and Wise analysis, which then has the following reports, lots of reports, but the key ones. We do an annual cash flow analysis, which basically means do they have enough liquidity to fund their income needs throughout retirement. Number two, we look at their liquidity over time after funding their need for income. I'm looking at the bottom left there. Those are the reports, the key reports. We look at their net worth over time because that'll include their liquidity and their illiquid assets. We look at their estate value, and then we look at their net to heirs after they pay tax on the qualified plans and so on. So what Chris Jacob's going to show is he's going to show a base case Wealthy and Wise scenario. And then he's going to show you how that would change if this same client used the Chief's home equity funding and repositioned that cash from that fractional sale to Cornerstone, the company that has the Chief's product. If we reinvested that cash in a LIRP, and you can see that's the very first choice, a life insurance retirement plan. And then we're going to run the same reports. We're going to look at the annual cash flow analysis. Did they have enough money every year throughout retirement? We're going to look at their liquidity over time. We're going to look at their net worth. We're going to look at their estate value. We're going to look at their net to heirs. Are they better? Or is the liquidity better or worse? Is the net worth better or worse? And we're going to compare those two things. And I think you're going to be shocked by the results. And so the other thing you should notice about this is that if a client does a Chief's funding, they don't have to fund a life insurance retirement plan. They can buy a boat. It's just extra liquidity. But in future episodes, we're going to show how the impact would be if that client took the money and put it in mutual funds, or put it in long-term care, or put it in disability income insurance, or put it in immediate annuities for your older clients that might be uninsurable. And again, we're going to run the comparison and see if things are better or worse. They say the best prospect is an existing client. I believe that what we're going to show you today, you can go back to every single client you have, especially the ones over 50, and explain this Chief's product as an option to improve their overall financial plan. Last thing, before I turn it over to Chris Jacob, this is the first home equity product that's designed for well-to-do A credit, and there's not financial underwriting. When I say A credit, I don't mean that. I just mean pretty much every other home equity product is designed to help people with liquidity, whether it's a HELOC or a reverse mortgage. This product isn't designed for that. This is designed for the client that isn't desperate for liquidity, so they'll pay any interest rate to get it, like with reverse mortgages. This product is for the client who sees this opportunity of repositioning some of their home equity liquidity as a financial planning device to improve overall long-term results. And the reason it works, and you're going to see this here in a minute, is because the long-term APR cost of the Chiefs product is extremely low, and it's something that well-off clients will accept. Whereas a well-off client's not going to do a reverse mortgage where they're paying 10% a year, the effective APR. And so, with that said, I'm really excited to have Chris Jacob kind of run you through this initial scenario, scenario one, scenario two with Alert. We also have the two co-founders of Cornerstone here, Dan Anderson, Craig Korn at the end. We're going to have a question and answer session, and they're going to help us with any questions that you have. So, Chris, take it away.
All right. It's an honor and a privilege, and I want to thank InsMark for allowing me to illustrate this new Chiefs program. And I too, like Don, since I've been a user since 1987, I think it's the most impactful thing that's come to the industry. And pretty much the only way you can explain how it works is InsMark. And I want to thank Craig and Dan for creating this because I think it's magnificent. I think it's really going to be a game changer. I'm going to start the beginning with the end and show you the output of a Chiefs transaction versus status quo. We'll get into the Wealthy and Wise module in a second that produces these reports, but let's just look at something. We're first just going to compare somebody under current status quo that wants to generate 170,000 a year, adjusted for inflation at 2%, compared to that same person who is going to monetize a portion of their home equity with Chiefs, and we're going to reinvest that into a life insurance retirement plan and have income start generating year 11. You, you haven't seen these reports before. They're only available in the advanced module. Notice we've got spendable cash flow, but now we have a comparison to liquid assets. And I'm going to show you these graphically, but just from the numbers perspective for a minute. Look at year 20, same income, status quo, $2.8 million. With Chiefs, they have $3.8 million of liquid assets. If we go out here to year 30, you're going to see the same income, double the amount in liquid assets. And if we get out the life expectancy, you got an extra 2.8 million, and here you got an extra 3.6. Some people are fact find validators. I got to see the spreadsheets and where the numbers came from. What's great about InsMark is we can also show people graphically those representations. So here it is, 20 years, differential, $1 million in liquid assets in favor of Chiefs, which, by the way, stay tuned for coming attractions of Dan had talked about, and we're going to have right under here the percentage increase with Chiefs, and that's a 34% increase. If we go out to 30 years, same income, and that is a 95% increase in liquid assets. Let's get out to life expectancy, okay? At life expectancy, that is a 239% increase in liquid assets. And you're going to see just for a small part of the home getting monetized. And if somebody makes it 40 years, I think my math is correct, that's a 1,330% increase over status quo. Pretty big deal, okay? Um, so we also, this is the comparison page that we had before, which was good, but you could only show net worth here as a comparison, which doesn't tell the whole story. 4.2 versus 5.4, still good. But now we also have the option of this comparison. Spendable cash flow, wealth to heirs, but that yellow is joint life expectancy, difference in liquid net worth. And you can see we still generate more wealth to heirs by a significant amount, $2 million. Okay. Same cash flow, 2 million more to heirs, and in 40 years, you've got $3.6 million more in liquid assets. Do you want to be person A or person B? All right. Later on, we'll look at what can you generate with Chiefs. You can actually generate $200,000. And without going through all the numbers, I'm just going to go to this. At life expectancy, you got $800,000 more cash flow, you get infinity more in liquid assets. And if they make it to 40 years, you've got $2.1 million more in cash flow by implementing Chiefs and Alert, and you still have $673,000 in liquid net worth. Okay. So where do we
Yeah,
go?
Chris, I just want to jump in.
Go
This
right ahead.
second graph you're looking at is where we increased the income above what the status quo could provide. We took it from 170,000 to 200,000 a year. And in that scenario, the status quo, where they just keep going the way they're going, they basically run out of assets other than their social security. And that's why, go back to that graph showing how much more income the strategy two has. If you show the income, that's why the income is $2 million more, because instead of 170,000 a year, we're showing 200,000 a year, which could not be supported by their current plan. So I just want to reinforce that the impact of doing the Chiefs home equity fractional sale is we produced more than $2 million more of net tax-free, net after tax income to the client. That is a massive, massive difference. Anyway, go ahead, Chris. I'm sorry.
Yeah, no, please, Don, jump in at any time. Sometimes I had some clients once, and about 10 minutes into the meeting, they said, Chris, stop. Janet and I have Migo. I said, what's Migo? They said, my eyes glaze over. Okay. So I sometimes put people in the Migo stage rather early. Uh, let's go to where do we produce that from? And this is the new InsMark Wealthy and Wise module. All right. So what I did is I created a status quo, and let's look at what their balance sheet consists of under status quo. And it consists of the following: $1.2 million of non-IRA assets, 1.1 million of qualified IRA assets, and a home, which in this case is paid for completely, no debt, 1.5 million. So they got 3.8 million. They want 170,000 starting in year 11, adjusted for inflation at 2%. That means they need assets that can deliver roughly $7 million of net after tax cash flow. Where will it come from? Well, for this couple, really the only income source they're going to have currently is a Social Security income at 36,000. I know you get adjustments for inflation, but typically that's offset by Medicare and Medicaid payments. So I just kept it flat. So when you go up here and say, okay, this is what we need for livable, spendable cash flow, here's where it's going to come from. What they're going to do is first draw down upon their non-qualified assets, then start taking required minimum distributions only. And once these are depleted, then they're going to take more than required minimum distributions. So we've got $1.5 million, I'm sorry, $1.2 million of non-qualified assets with a $700,000 cost basis, assuming a 6.5%, a 35% tax rate, and a 20% cap gains rate. So when they need this 170 here, here's the gross amount that they will sell in equities in order to, after tax, provide that amount of income. As you can see, that's gone after 30 years. Here are their qualified plan monies, which too were growing at 6.5%. And what you'll notice here is up until year 29, all they're doing is taking required minimum distributions. However, once that non-qualified plan runs out, they're going to be forced to take more than required minimum distributions. So their liquid assets looks like this. I mean, it's kind of cutting it close with liquid assets. Yeah, that 170 will carry them, but just die before age 40, because all they're going to have left is 266 in liquid assets. Which, by the way, you guys are, if you're sharp enough, you look back here and say, well, I thought that was 410. Um, it is. That's the pre-tax value minus the tax due. It's 266. More information than you need or want to know. There is a button that you can toggle that you can show retirement plan assets pre-tax value if you want. I like to say Webster's definition of gross is ugly and you don't get to spend it. So I show the net on that. Here's their home, growing at 2%. And from a net worth standpoint, this is what they look like after providing the required cash flow. There would be some tax when the second spouse dies, income with respect to a decedent on any remaining qualified plan assets. We put that at 35%. So what goes to heirs? Those total estate assets that we looked at on the other side, minus the income with respect to a decedent taxation on the IRA. Column 5 is what heirs walk with. All right. What I did there is I cloned status quo and I created the Chiefs scenario. What's going to be different in Chiefs is we are going to monetize part of that home equity.
We've partnered with InsMark, the leading provider of insurance and investment planning software, through their Wealthy and Wise platform to integrate our Chiefs product and program into their planning tools in order to provide the thousands of advisors who use their platform today in a compliant manner the ability to compare a client's status quo scenario against a financial planning strategy involving Chiefs. Let's kick off this session talking about home equity instruments, and better known as HEI, and how you can use HEI products to better serve your customers. So I'll start with this. HEI are home equity funding instruments that have been used for several decades now. The easiest way to think about them, in my opinion, is they allow homeowners the ability to sell a fraction of their home in return for a lump sum of money without the requirement to make any monthly payments while the transaction is outstanding. HEI products literally change the paradigm that an individual can only own either 100% of their home or 0% of their home, which makes them a renter. HEI products allow homeowners to sell a fraction of their home, yet still retain 100% of the utility benefits associated with home ownership. While most HEI products have a fixed maturity date, typically either 10 or 30 years when the contract must be unwound, Chiefs have no maturity, with repayment being triggered either by death, permanent move out, or voluntary repayment, which creates great flexibility for the borrower. It's something that we learned from the reverse mortgage space. We thought that was an important feature to incorporate into our Chiefs HEI product. HEI products are typically allowed only on owner-occupied properties, which can include a second home, a third home, or any number of homes that your clients occupy but don't use as investment properties. In addition, HEI products can be executed on residential property that have an existing mortgage, where HEI and Chiefs can sit in a second position behind the existing mortgage. HEI products have been structured to provide homeowner protections, such as the homeowner always retaining a financial interest in the home, typically a minimum of 20 to 50% of the value of the property, to ensure appropriate alignment between the homeowner and a company like Cornerstone Financing. Other protections include capping the costs the homeowner can potentially pay out, typically as low as 12.99% annualized cost to as high as 19.99% annualized cost. And this is to protect against the risk that home prices shoot up so dramatically that the homeowner is paying out much more than the upfront benefit received at the time of transaction. In addition, and this is important, HEI also share in losses should home prices depreciate over time. It truly is like selling a portion of your AUM with protections in place to avoid severely negative outcomes to the homeowner. Cornerstone's chief product is an HEI product designed for the mass affluent and higher net worth demographic served by financial advisors such as yourselves. We created Chiefs to address perhaps the most challenging part of providing financial advice, which is how to fund the products and strategies so important to your clients recommended by you all. Historically, the options are pretty limited to either cash on hand or AUM liquidation, which have their own consequences, such as reducing your client's liquidity or having to address tax implications of what is oftentimes a highly appreciated stock portfolio, putting aside the fact that AUM liquidation eliminates future opportunity gains. And as you all know, where you invest your clients' money matters. The stock market has outperformed the housing market by nearly 8% per year over the past 80 years.
What's going to be different in Chiefs is we are going to monetize part of that home equity. They still got the same desired cash flow. They still got the same expected cash flow as Social Security. They still got the same $1,000,001. Okay. Liquid assets, they still got the brokerage account, but notice I created a new account here, taxable, Chiefs reinvestment account. So when the money comes from Chiefs, we're going to reinvest it in this taxable account, earning 2%, and fund 7 premiums into, we'll call it a maximum efficient contract, minimum death benefit, maximum cash in order to generate income. And this is where it gets interesting. You check the box. And when you check the box, you go to edit details. You're going to see this 50%, that's the cap. It can be lower. We'll talk about that and how you get there in a second and what that means. Age doesn't really matter. There's some origination fees, other fees. And this will show you what is the max that can be derived in this particular transaction. And you'll know one of the neat things here is that Chiefs, no matter what is owed to Chiefs, they can never get more than 50% of the home value. So you can see here in 15 years, the home value is 2 million. The max that Chiefs can get is $1 million. And Dan and Craig, I questioned you on this, and what is the answer? Because I know people are thinking of it. Yeah, but what if I sell my home here and I only get $1.6 million for it? Or what if there's a tornado? It wipes out my house and the insurance company only gives me $1.5 million for it. Even though Chiefs is entitled to that, what do they get, Craig?
Yeah, Chris, really straightforward. If the house goes up in value, the most we're ever entitled to in this scenario is 50% of the value of the property. And likewise, I'll stretch a point to make a point. If the house were to sell for $100,000 20 years from now, we'd be entitled to 50% of the value of the property. So we take a lot of risk on the downside, but we cap our upside, as you can see there in column 4, to a maximum return of 12.99% on our money.
And question, when they receive these proceeds, are they taxable?
They're not. Any tax implications occur at the time the house is sold.
Okay. And I've got another question for you. I know people are going to want to know, is this just on their primary residence? Can it be on other properties? What defines a Chiefs transaction for property?
Again, very straightforward. You can do it on your primary residence, your secondary, if you have a third or fourth home. You can do it on any owner-occupied property. You just can't do it on rental properties.
I think that gives us a pretty large target, a target-rich environment. Going back to all your clients, how many people that you work with have their homes paid for or mostly paid for, and now we can monetize for them a dormant asset. Now, Don said people were going to want to know, inquiring minds want to know, how does this compare to a HELOC? So let's put in a HELOC for 10 years, pay it off in 20 years, interest only for 10, and then you start making the principal. It's amortized for 30 years. It's at 8%. Is that what we should have in there, Don?
Yes, that's good.
Okay. And let's look at a reverse mortgage. Here's the parameters for a reverse mortgage, which, by the way, I've personally dealt with a reverse mortgage for my mom. Um, we had a reverse mortgage for her after my dad died in order to help her supplement income. And she eventually went into a nursing home. And when she went into the nursing home, the reverse mortgage outstanding loan balance was $300,000. The house appraised for 280. So we just had to say bye-bye. So I've lived through that. Okay. We got that in there. Now, one of the things we want to do, we want to include insurance. So we go to the other assets, and now I'm going to click proposed life insurance. Okay, in order to get the numbers from the life insurance illustration in there, we are going to do the following. And this is the illustration we're going to use. It'll work with whole life. It'll work with variable universal life. This happens to be an indexed universal life. Doesn't matter. It works. So we're max funding at 48,460. How do I know that's the amount? Because when that Chiefs money goes into that 2% yielding account, that drains the account over 7 years. And then we're going to start having $40,000 of income generated, projected but not guaranteed, in year 11. How do I get that in there? And the answer is through this program, Repredict. Another person I have to give kudos to and thanks to is my partner, Bob Strauss, on the screen. I might have been the impetus for this, but he was the genius behind it. It's a patented AI-assisted predictive spreadsheet. We're not going to make this an advertisement for Repredict, but you're going to see it's pretty easy to transfer values from an insurance illustration into here, in addition to doing all the what ifs. There's a little video you can watch on it, but I think Don said it best. It's a powerful artificial intelligence platform that increases efficiency and effectiveness for producers. What used to take 15 to 30 minutes per change now only takes, you're going to see milliseconds. The Repredict platform helps our customers learn and implement InsMark strategies more quickly because of lightning fast back and forth. All right. So, like I said, we'll ultimately illustrate its predictive capabilities, but for the time being, and I could go through it now, but I didn't want to waste time. It's rather easy to transfer data from any PDF. So how do you get data into InsMark? If you're working with one of the carriers that InsMark has a button for, you can do it that way. If you're working with a carrier that doesn't have the button, you can do the old copy and paste, but sometimes you get the subtotals in there. It's a pain in the rear. And there are some carriers who have their PDF illustrations locked out. You can't even copy and paste on them. So what we did here is we imported this. See this little button up here that says Plan with InsMark? We're going to click that. And when we do, I'm going to load this data. So you can go in and you've got agency over filling in these things, okay? And if I move this, you'll see it brought in the correct death benefit, brought in the age. Obviously, I put that in, and I put male in. Those are the things that can't glean from Repredict. And then it matched up, has a smart match for all of those values. What do we do at this point? We just hit submit. And what it's going to do is going to transfer all that data over to InsMark, similar and tantamount to what you would do with a button file. And depending upon whether you work with InsMark via online through the cloud, or like me, it resides locally on my computer, I'm going to press Wealthy and Wise. It's going to transfer that data into the data files. By the way, don't do anything here. When that pops up, just let it do its thing. Now I know that's been transferred in. So I'm going to go to import. And let's see if it transferred. Yep, there it is. And let's just look, do we want to modify anything? Well, we probably don't want to illustrate it for 60 years, so we'll do 45. And policy details, it brought in the death benefit, it brought in the interest rate, brought in the proper footnote. There's our premiums, there's our loans, and here's the cum surrender and death benefit. I like it. Okay, that's what I want. Just like that, presto changeo, it's brought into here. All right. So under illustration details, what I have is the following. Prioritize use of assets. I want to use that Chiefs reinvestment account first to fund my life insurance. And to the extent there's excess cash flow, I want 100% of it going into that Chiefs reinvestment account. Because when the money comes in from Chiefs, I need to direct it to go in there and have the premiums be paid from that account. When I go to report selections, and I know this looks like a lot, but I'm taking it easy on you. We could put all these in too. I do the following. Notice these two in here. This is new. Chiefs plan details, Chiefs plan versus reverse mortgage. Let's just go through this and you'll see the first several, we've always seen this great down and dirty net worth sheet, but notice there's a new addition here now that we have this life insurance death benefit available. And in addition to desired spendable cash flow of 170 adjusted for inflation at 2%, we now have what's termed dedicated cash flow. We want that to fund premiums for life insurance. Before we had the $36,000 of Social Security coming in, but notice we now have a new account value coming in. This is money derived from the Chiefs transaction. And now we also have loans coming in from our LERP design policy. So here's our total expected after-tax cash flow. When you look at cash flow required, dedicated, and spendable versus provided, you'll see, just like in the other one, we don't run out of money. In that first year, when the 326,437 comes in from Chiefs, we're going to peel off 40,460 to go into the life insurance. And then we are going to make those remaining premium payments from that account. Notice down here too, we're taking equity money and we never run out. As you're going to see, all we're going to ever take from this point forward is required minimum distributions from our qualified plan. Here's my Chiefs account. There's the money going in after that first premium is paid, and that's the premium being paid over the next 6 years. We got our life insurance funded. Here's my equity account. Notice this doesn't run out of money, okay? If you look in 40 years, that's $2,085,000. I'm not going to go back to the other one, but there was zero there at that point. And if we look at the IRA, notice we are never taking more than required minimum distributions. If you recall, there was 266,000 left in there after tax. What do we have left in there after tax now? 1.5 million. You're getting a lot of juice for the squeeze for repositioning $326,000 of assets via this Chiefs transaction. Here's our liquid assets. Now, in the comparison reports that you'll see, it doesn't include this life insurance cash value. There is a button that you can have toggle on or off as to whether you want to show this in liquid assets. I want to show it that it's there, but the reports that you see won't have that included. All right, this is the big kahuna page on Chiefs. We got $1.5 million house growing at 2%. We're going to get money from Chiefs, and you'll see Chiefs percentage APR. And really over time, the longer you keep this, the lower that gets, especially compared to a reverse mortgage or a home equity line of credit.
And Chris, there's been a bunch of questions about, explain to us this Chiefs. How do you get money from the home equity and how does it work? Let's just take a second. And Dan or Craig, if you guys could chime in and kind of explain, the sort of profile client, how you figure out how much you can advance to the homeowner. Let's start with the maximum amount you can advance to the homeowner. Kind of explain that to everybody and kind of how that works.
So Chris and Don, we've made reference on a number of occasions to the most that we'll ever take is a 50% share of the property's value at some point in the future when the homeowner decides to sell. And it's probably worth noting that there is no stated maturity. If the homeowner happens to live to 150, there's no obligation to repay the chief until they pass away or decide to sell the house. So it gives ultimate flexibility from that perspective. What we do is we make effectively an investment in someone's home, and that investment is paid
from Cornerstone to the homeowner. Obviously, the advisor and the homeowner are determining how those chief proceeds are being used. Chris, in this example, the assumption is that those chief proceeds are being used to fund a 7-year premium LERP. And how chiefs work, very, very simple. On the day that we make that effective investment in one's home, we're entitled to a certain percentage of the value of that property on that one specific given moment. And you can see that in column 7, where our effective equity share percent, the quote unquote ownership. Chris or Don, if you can bring that up to year 1, that would be helpful.
Oh, there you go.
At that very singular moment after year 1, we're owners of 24.62% of the value of that property, whatever the value of that property may be. And over time, that ownership interest will grow, and it will ultimately grow to a cap of 50%. Why is it structured that way? We do that very simply to allow Cornerstone to generate a commercial return on the $360,000 or so that we originally invested in this particular individual's property. And ultimately, our risk is as follows. If home prices were to fall, as I mentioned before, our return would be 50% of that depreciated property. If the property were to appreciate over time, the most we can ever make, and you can see that in column, I'm trying to see column 6 there, the most we can ever make is a 12.99% return on our original $350,000 investment. So we cap our upside, but we do not have a floor on the downside. And it's important to note, Chris, Don, I think these are things that folks on the call will want to hear about. Once that individual receives that money, there are no payments that they have to make. That's very different than a HELOC. And to some extent, like a reverse mortgage, what is ultimately owed to Cornerstone will grow over time, but we cap it to 50% of the value of the property. And we do that because we want our customer, the homeowner, to always have a significant amount of interest in the value of their property. It creates alignment between Cornerstone and the homeowner, and we think that's really important. In effect, we're partners with the homeowner.
And Craig, this number here, this combined loan to value, the max is 50, but that's fungible, right? If somebody said, I only want to have it so that they can ever get 40%, well, that's what happens. Now you're limited to this, right?
That's exactly right. So a homeowner can sell 10% of the value of the property, they can sell 20%, 30%, but the most they can ever effectively sell is 50%.
Yeah, and I want to make the point that it's like, well, what's the market for this? Who are you guys trying to talk to? The answer is 41% of all homes in the United States have no debt, no mortgage. They're paid for. 41%. So the target client, they're over 50. They're relatively well off. So basically everyone who has a financial advisor, that would be a highly correlative statistic. So they're in their forever home, they're 50 plus, and they're relatively healthy. And again, if they have assets and income and they have some wealth, they're going to tend to live longer. Why is that the ideal client? Well, because the reason Cornerstone is able to structure this so that over the long term, their APR drops down to 5%. If you scroll down in 30 years, what's being paid to Cornerstone is over 30 years is 4.87%. And so if you have a client, let's say you have a couple, they're 55 years old, husband and wife, they're looking at this saying, we're in our forever home. In other words, yeah, we might buy a vacation home, but this is the home, this is where our friends are, this is where we're going to be till we're dead or in a nursing home or whatever. We're not going to move to Hawaii. We're going to stay here wherever they live. So you're looking at people over 50, you're looking at relatively healthy, where they're going to be in this home, one of the two of them, if they're married or have a domestic partner, they're going to be there at least 10, 12 years or more. If somebody said to me, hey, look, we love our house, we're probably going to move to Hawaii in the next 10 years, don't do Chiefs. You would never do that because the cost of the money is too high. But if somebody said to me, no, one of us is probably going to be around at 80 or 85 or 90, this beats everything else. Look at the 20-year APR. Scroll up. 20-year APR is 6.33. Okay. Well, HELOCs are non-deductible interest, which you're going to be at 8%, but it's really more like 12 because unless you're building a new kitchen, if you use the HELOC money for anything, it's non-deductible. The other reason the HELOC's not an option is you've got to pay all the HELOC money back. Typically, there's a 10-year interest-only draw period, and then a 10-year period when you got to basically pay back most of it, and then there's a balloon payment. So that doesn't even compete with this, where the client never has to pay the money back like a reverse mortgage until they are going to go in a nursing home or die or whatever. And so no payments, nothing. But unlike a reverse mortgages are going to be, when you add all the fees, they're going to be at a 10% APR. So there's none of your A credits, none of your successful clients are going to do reverse mortgages because they know, why would they, on money they don't really have to create liquidity out of, why are they going to pay a reverse mortgage lender 10%? They're never going to do it. The difference with Chiefs and why it's such a brilliant product for a certain type of client profile is if you've got a client in their forever home and they're relatively healthy, and yeah, one of us is going to be in this home for 20, probably 30, maybe 40 years. And one of us is probably going to live in our 90s. You're looking at a 5% APR. And so a successful client who doesn't need the liquidity is going to look at this and say, yeah, I'll create some liquidity out of this and reinvest it in an immediate annuity if they're 80 years old and they're uninsurable, or I'll get some liquidity from this and reposition it into a long-term care policy or a LIRP or whatever product you want to analyze. That's the lane. That's what's completely new about this. And a home HELOC doesn't even compete. You got to pay all the money back. So that's really a short-term liquidity need, not a long-term financial planning improvement.
Don, something I'll add to what you just shared with the audience is to date, the typical Chiefs customer is an individual with a roughly $2 million home. And they're typically taking out, ironically, an amount of money that's very similar to the amount that we have been showing the audience, $325,000. Roughly half the time, they have no mortgage on their home, and the other half, roughly, they have a small mortgage on their home. And it's worth noting that Chiefs do not have to be in a first lien position. They can actually stand behind an existing mortgage. And that's actually a good thing for a lot of people because, certainly those individuals who've taken out mortgages over the last, 5+ years may have benefited from the low interest rates of a few years ago. And who wants to pay off a 2.75% 30-year fixed rate loan?
So, Craig, I'd also like to mention and remind the audience, there's no financial underwriting with a Chief. The only underwriting that's done is equity underwriting, and the process is real simple. We get a third-party commercial appraisal. After we agree on the appraised value, we go to title and we fund. It's that simple.
And then, Chris, before you jump in, we were talking a lot about, when the payoff occurs 10 years, 20 years, 30 years later. The payoff of a Chief and the insurance policy that you purchase have nothing to do with each other. You buy that policy on day one and you happen to decide to move after 5 years because your children are going down to Florida and you want to be near them. Your policy remains outstanding and you've paid off your Chief. So unlike traditional premium financing, there is no connection between the policy and the Chief payoff.
Because of that, we don't participate in any commissionable event on behalf of the
They don't take commissions, they create
None.
commissions. All right, let's look at what happens when we incorporate Chiefs, and we're also going to do a couple of different comparisons here. So when we go into the details, here's what you see for Chiefs in terms of 50% is the max that can ever be owed to Chiefs, and this is what we're showing as the max that can be derived from the $1.5 million with a 0 mortgage. See these buttons along the side, HELOC and reverse mortgage? Because invariably somebody's going to ask you, how does this compare to a HELOC? So let's look. If we edit the details, And Don, tell them what you know about reverse mortgages that most of us don't know.
Well, we're coming to reverse mortgages. We'll start with the home equity lines of credit. The way HELOCs work is you typically have a draw period, typically 10 years, where the borrower needs to make interest-only payments. And then you'll have a repayment phase, kind of the phase two, which is typically another 10 years. So in this particular case, we say the interest-only draw period's 10 years. The payoff in year 20 means the repayment period is 10 more years. And then during that repayment period, they typically set the payment not interest only, but they set it as an amortization payment, typically based on a 30-year mortgage of the principal balance at the end of the first 10 years. So that what happens is you have a higher payment in the phase two, second 10 years, and then at the end of the 20 years, you'll have a balloon payment due to pay off and pay back the entire HELOC advance. The origination fee of 1.5% is typical. Couple $1,000s in appraisals and other fees for a HELOC. And today, competitive HELOCs are running at about 8%.
Now let's go what I was talking about the first time, the reverse. Click the button. Now we can go into edit details. And remember, it's a home of 1.5 million. So 2% of that would normally be 30,000. But why is it?
Yeah, so with reverse mortgages, there's pretty high costs up front. You're typically going to pay 2% of the home appraised value, and as you said, capped at $24,195. Then there's an origination fee in addition, which is typically 2% of the first 100,000 in home appraised value, 1% of the next 100,000, and 1% of the next 100,000, capped at $6,000. So if you have a home that appraises for 400,000 or more, you're going to pay the 6,000, and then it's capped. Again, you'll have your closing costs of appraisal fees and a few other fees, so that's a couple thousands typical. And with reverse mortgages, they typically quote the interest rate inclusive of paying the ongoing 0.5% of appraised value insurance premium. Today, your most competitive reverse mortgages are running at about 8%. So I think that 8% is good.
Okay. So now that we've got those boxes checked here, there's going to be a report that we can now look at. In addition to the chief's plan details, which you see here, we now have the ability to compare both numerically and graphically the reverse and the HELOC. And notice something here. When do we get to a crossover point? At about, see the amount due to chiefs and the amount of the reverse mortgage that's owed? There's a crossover point there right at about year 15, Don?
Year 13. Year 13, because your Chiefs is
Yeah.
8.74 and your reverse mortgage is 8.87. So year 13 is the crossover year.
And then you get down here further and look, in 30 years, ostensibly, you could owe the entire value of the home at that point on your reverse. And Chiefs is only at 50%. So
Yep.
there's the numbers. Here's the graph.
Yeah, this is very interesting because as you'll see, the reverse mortgage in purple, it's the purple line, it's very expensive if you need money for 3 or 4 years or less. Then the reverse mortgage very quickly over 5, 7, 10 years, the average APR drops, and you can see it there at its level. But look at the brown line. That's the Chiefs APR. And so again, there's our 13-year crossover point. And then every year after that, because Chiefs is limited to 50% of the value of the home, it's going down, 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 down. The longer the client or their spouse is living or domestic partner is living in the home. So if I were talking to a client, a 55-year-old and 54-year-old husband and wife, my question would be simple. Do you think one of you is going to be here in 15 years? And if they're in relatively good health, the answer for most people is yes. In fact, I think most people, one of them is going to be here not just in 15 years, but in 30 years. At age in the mid 80s. Both my parents are still in their homes and they're 90, but both of them are 89 and 90. So that's a high probability. And as you can see out at age 85, the Chiefs is 4 or 5%. The reverse mortgage is 6 to 7. That makes a massive difference. That's the difference in giving up your entire home equity versus only half of it.
Yep. Yeah, I'm 64, and I told my wife the only place I moved from here is 6 feet under. So I got a I got a feeling a lot of people 55 and older, it's their second, third, maybe fourth house, and they're not planning on building again.
Yeah, the ideal client for Chiefs is over 50, in reasonably good health. Couples obviously better because you have two people that could potentially be in the home for a longer period of time. And it's the home we're using the Chiefs on is their kind of forever home. It's, kind of where their friends are, where they plan to live. They might have a vacation home or two, but this is kind of their main homestead. That's the perfect client for Chiefs because one of the client's going to be there for at least 15 years. And then over time, they're going to have a much lower cost of funds than either a reverse mortgage or a HELOC. And in this case, the HELOC APR is assuming interest is deductible. It would be, 13% if it's not deductible. The HELOC really doesn't compete against Chiefs or reverse mortgage because you gotta pay all the money back during your lifetime. In this case, over 20 years, it's really not accomplishing the same thing that Chiefs and reverse mortgages accomplish, where you effectively really don't have to pay the money back until you leave your home, and it's really an estate reduction at that point.
So there you have it. For those fact find follow through people who need the, show me the numbers, we've got this page year by year numbers. And for those who just say charts and graphs, that's really all I need. There's your picture worth 1,000 words. All right, what's interesting now is we've got the gross value of the home growing at 2%. They didn't have any liabilities before, but now here's the max amount owed to Chiefs in any given year. When we put together their net worth, this is the home net of the Chiefs liability. Here's the cash value of the life insurance. Here's the after-tax value of the retirement plan assets. Here's our Chiefs reinvestment fund funding life insurance. And here's our non-qualified equity fund. And you can see they've got a pretty healthy net worth there. There would still be income with respect to a decedent taxation on any remaining qualified plan assets, total estate assets, minus the transfer tax, net to heirs, wealth transferred. And what does InsMark do best? We went through those two scenarios, do it versus don't do it. So that's what I've created here. And if I go into the edit, I've put in the names, how I want them to read on the output, and I've selected my reports. This was never available for, and it isn't. If you go to your current Wealthy and Wise system, there is no numerical comparison of liquid assets, and there's no ability to actually define those graphs at different years. So most of what you see on here is brand new as it results to this Wealthy and Wise advanced module. So if I hit preview, basically what you're going to see here is what I showed you in the beginning. This is the comparison of liquid assets. There's the various graphs at 20 years, at 84, at life expectancy. There it is if somebody makes it out 40 years. And there's what this one is in current Wealthy and Wise. What's not is this one, liquid assets, which really tells the tale of the tape. Because if you go back here and look at net worth, okay, yeah, we're $1.2 million better off, but we're $2.8 million better off in liquid. That's a big deal, right? So we can then go ahead and create our booklet for the client by hitting this, dragging over here what we want. You guys are gonna get with this workbook, so I'm gonna give you guys the one for the 170, and without going through all the numbers, we looked at this before too. How much juice for the squeeze can we get out of Chiefs with alert? Well, we can get 200 grand and not run out of money. There you do. And you saw this before. Here's what the graphics look like. At life expectancy, $800,000 more, $1.5 million liquid versus zero. And all the way out here at 40 years, $2 million more, and still have 673,000 of liquid. And as Don talked about, and I've run this just by saying, okay, we'll just take the Chiefs money and put it in my brokerage account, do nothing else with it, or I'll put it in that 2% account. the delta between liquid assets on the do it versus don't do it is still tremendous. What about putting it into a tax deferred annuity with an income benefit rider down the road? That blows doors. What about converting a Roth and either taking the taxes and status quo from your brokerage account to pay the Roth conversion tax, or using the Chiefs money to fund the Roth conversion tax? By not having to sacrifice opportunity cost on those brokerage account monies, you're going to see it's a huge difference. I mean, stay tuned for coming attractions. One other thing I did want to show you, you'll see there's new buttons here too. You've seen these probably before, Repredict and Chiefs. One of the things that Repredict can do for us is if we take that life insurance illustration in Repredict, when I'm in the edit mode, I can create columns before, columns after, and that's what I did here. So this is the life insurance illustration that generated the income here that we imported into InsMark. Notice I just created a column for home value and I created a column for Chiefs proceeds. What would happen? I mean, they're going to get the house appraised. Let's say the house appraisal comes back for $1,700,000. Guy said I liked it for $1,500,000. I like it even better at $1,700,000. What do all these numbers look like if we do it for $1,700,000? Let me go back to the office. We'll run some illustrations. We'll get back together next week. Here, we just mark this like this. Mark as dependent. We change this to $1,700,000. And in a nanosecond, when I hit predict all, boom, that changes everything. It tells me that'll be the chief proceeds. This will now be my premium. Should produce something close to $45,900. And as a real quick reference, I did this for you, so you don't have to go back and see it. Let's see right here. Well, if you put that money in, what was it, 45,900 before, and now it's 45,960, 251 and 353 at age 85. And what was our predicted? Our predicted was 251 and 353. It's 99% accurate. Well, let's use Don's example. The guy says, I like the plan, but I really been wanting to buy a boat for a long time. And the boat's about 75,000. So let's just use 76 of these proceeds to buy the boat, and the remaining assets will go toward the Chiefs transaction. What does that look like? We're still going to use the same $1,500,000 starting home value. We're still going to get proceeds of that, but we only want to fund the LERP with 250 from Chiefs proceeds. What does that look like? I'm not going to show you the numbers. They're 99% accurate. Okay.
Yeah, I promise you, this Repredict platform is so it's so close to the. If you went back and reran the Carib proposal, and I've looked at 50 of these, it's so close you can't believe it. So you just, I promise you, their numbers are accurate.
Yep. By the way, if you're interested in Repredict, learning more about it, you can go to repredict.ai. It's not repredict.com. And in the InsMark, by the way, for those of you who want to review the webinar on this, you just go to training and videos, and you'll see them archived here. And we'll also have the download of the PDFs in here. And furthermore, you can also get to Repredict by going to alliances, strategic partnerships. This is alphabetical, Don. Can we be like one Repredict so it comes up at top? I'm kidding.
I'll take that up with Tony and Debbie.
So you got to scroll down to find it, but there it is. And if you just click on that button, presto, change.
That's actually a really good idea, Chris. I'm all in favor of that. So
okay.
I like that idea. I like that idea a lot.
So I know I think I went 6 minutes past my allotted time. I could continue to give all of you Migo. I don't want to do that. Don, you may want to talk about how people can go about working with the new module, if you will.
Yeah, so let me just say a couple of things first, make sure I'm unmuted here. So let's talk a little bit about the potential market here. So in the United States, you got $35 trillion of home equity. That's the current number. We know that 41% of all homes have no debt. So if we ignore the percentage of homes that have very little debt, which is a percentage, let's take all the homes that have no debt. That's 41%. And if we took 41% of 35 trillion, that's 14 trillion dollars, give or take. And the Chiefs program advances, 22%. So let's say 20% of that. That's $3 trillion of home equity before we even talk to one client who doesn't have a paid off mortgage, but has a $2 million house with a $50,000 mortgage. We're not even including them. So worst case, there's $3 trillion of money to go get to use the Chiefs program with well-to-do clients, older, well-to-do clients, which is exactly the country's demographics. I don't have to tell anybody that. I mean, we're Japan, essentially. So you've got a lot of people over 50 with lots of assets and resources and equity. And we can now say, hey, let's analyze whether if we take some of that equity out with a program that's very low cost for long-term buyers. Let's reposition it into, as you can see on the right, go back to that flow chart. That was beautiful.
There you go.
If you see on the right, let's reposition it into, how about fully funding a disability income policy for a 50-year-old? That his company paid disability income is insufficient. How about fully funding that? What's the value of that? How about fully funding a long-term care policy right now, so that the kids don't have to worry about a, $500,000 bomb that hits when mom gets sick in her 80s? Is that worth anything? So I don't know. Well, we could go, and we will, but let's take a long-term care policy. We could do scenario one where mom gets sick at 82 and there's $100,000 a year cost for 6 years. And we can do scenario two where we do the Chiefs transaction and fully fund long-term care for mom. We don't have that $600,000 bomb go off 20 years from now. Wonder which one's going to look better. So we'll do it. We'll do that in a future webinar. But this creates funding. It's sort of like the way that premium financing created funding for life insurance policies. Only I think this is, and hey, but premium financing is great for the suitable client, but this doesn't have a lot of the complexity and risk of premium financing. And so in many ways, I think this is an even better find the money opportunity. So with that said, let's open this up for questions. I've been trying. There's been more questions. I've done 100 seminars with InsMark probably over the last 6 years. There's been more questions on this product than in the.
Hey, Don, before you go on
ahead.
to the questions, you might want to talk about, because some people looked at this and said, gee, even if I get the module, I don't know if I'm going to be able to do what Christians did.
Okay. All right. Fair enough.
How to work with this?
All right. How do you get how do you offer this to your clients? Well, if you want to do this, you have to get the Wealthy and Wise Advanced software. It's not Wealthy and Wise, it's Wealthy and Wise Advanced. It's $2,250 and $100 a month. However, if you get Wealthy and Wise Advanced in the next week, we'll cut the price to $1,000 instead of $2,250. Then for the next 90 days, it'll be $1,500. If you already have Wealthy and Wise, the upgrade charge is $600 and it goes to $100 a month. Again, if you buy it the next week, you can get it for half, $300 upgrade. Then for 90 days, it'll be $450. Then once you have the Wealthy and Wise Advanced software, we offer free technical support. We have a forum that you can go and collaborate with other Wealthy and Wise users and share ideas. That's all free. We'll have monthly training webinars. That's all free. And then there are some other options. One option is you can hire case designers at InsMark for $300 an hour. We'll actually build the case for you. Or you can work with our case consultants, Chris Jacob, leading that team at the moment. And the way that works is if you decide to work with Chris, you don't have to have the Wealthy and Wise Advanced software. And if he builds the case for you, he gets a 25% case split. If he builds the case for you and also interacts with the client and their advisors, it's a 35% case split. So what we've tried to give you is sort of the do-it-yourself all the way to the giant red easy button on the desk. Look, I don't want to buy the software or learn this or do anything. Can I just have somebody else do it and I'll give them a piece of the case? So is that what you wanted me to explain, Chris?
Yeah, yeah. I mean, really, you're combining Chiefs, the power of Chiefs, which you've never had before. You're combining InsMark in a new fashion, which has never been available before, and it was compelling before, but it's even more so now. You're combining me and Bob at Next Point to create these, and you're also going to get repredict in the process to do all the what ifs in front of the client and play in the sandbox rather than have this turn into what's the saying, and I don't mean to be sexist. No one has endurance like the man who sells insurance, right? Because these things take a long time typically to come to fruition. Here, usually we're closing in one meeting.
Don, I'd like to add one thing to your comment regarding the software. The end user will still have to be paying the monthly maintenance fee. In case that wasn't mentioned, I didn't hear it mentioned. You don't have to buy the software if you're working with Chris, but you would have to you are required to pay your monthly fee of $100 a month to InsMark.
Yeah, you know what? That's my mistake. I apologize. So if you do decide to do the case consultant, you will get the Wealthy and Wise Advanced software, but we waive the upfront fee and you just pay the maintenance fee, the $100 a month. I'm sorry. You're right, David. My bad. I also want to mention that for those of you who know Stuffy Singer, he's also going to be one of our case consultants as well, along with Chris, Jacob, and Bob Strauss. So our goal is to have lots of support. But that's right, David. If you work as a case with the case consultants, you will get all the software. It's just that the upfront fee is waived. You pay the monthly maintenance. I'm sorry.
And it's waived if you close a case, right, Don, too? It's not, if you don't close a case within 12 months, then it comes back.
Well, then you can decide to pay the upfront fee and keep the software or not pay it.
Yeah, so use us to learn and then do it on your own. Go ahead with the questions, Don.
Yeah, and we hope to release. We don't even have the software released yet. We hope to release Wealthy and Wise Advanced with the Cornerstone integration by the end of the month. Could be sooner than that. Could be in a week. It's somewhere between a week and 2.5 or 3 weeks. But we're very close. Questions. So can Chiefs be done on more than one property?
The answer is yes. We've had a number of scenarios where I'll give you a perfect example. This transaction went down in California recently, where it was a primary home was paid for. They used Chief's proceeds to buy a second home, a cash transaction, but they supersized that transaction because we participated in that second transaction and provided additional liquidity. So now that individual owns two homes, debt-free. They don't own 100% of each home, but they're diverse. So the answer to your question, yes, Don.
Thank you. So since there's a partial, this is a question, since there's a partial sale of the property, are the proceeds taxable to the client now?
So Don, let me jump in. Like any residential transaction, when the property is ultimately sold, that's when the tax bill comes due and payable. If there's a taxable gain, of course, on the property.
Sure.
As I mentioned before, the concept around Chiefs and these equity sharing products is the sum of the proceeds you receive up front and your net proceeds when you sell the property form the basis of what your capital gain may be. That's the best way to look at it. And I know we're not in the spreadsheet, but if the house were to sell for $3 million down the road and we were entitled to 50% of that, so that's 1.5 million. By definition, the homeowner's entitled to the other 1.5 million, and that plus the 326,000 that they were entitled to on day one represents what they would be looking at as far as what their capital gain would be based off of. Of course, what their cost basis is what their cost basis is. We have no way of knowing that.
And Craig, they still get the 500, as a couple, they still get the $500,000 exclusion on the sale of the gain, right?
We certainly don't get it, so yes.
Okay.
I had a question. What if I already have Wealthy and Wise Advanced? Ellen asked the question. If you have Wealthy and Wise Advanced, you are good. You will get the Chiefs integration automatically when we release it in a couple of weeks. You are good to go.
So Don, I'm sorry. Let me just jump in. You mentioned something earlier that this is an opportunity. We found the money. I just want to expand on that. Our runway. We have a $285 million revolving facility, a revolver. We also are negotiating, just received an LOI on $1 billion asset-backed security takeout. So what that means, audience, we have $1 billion of liquid funds to deploy in insurance-related constructs in the next handful of months. And after that, we're going to reload. So what I didn't mention is the organizations that are providing the warehouse financing is Nomura, a large Japanese bank, and Aquiline. Each of those institutions have an ownership in Cornerstone. And that third entity I mentioned that's providing that $1 billion takeout, they will also have an ownership interest in Cornerstone. So there's alignment, and there's definitely some horsepower behind what we're doing in a big way.
So this is Don Harmelin had a great question. He said, let me just read it. Realistically, what's the minimum size fair market value with no mortgage, i.e. $500,000 fair market value, no mortgage for a $250,000 Chiefs loan? I think what he's asking, and let me elaborate. What he wants to know is, what are you all seeing at Cornerstone as sort of the average Chiefs transaction? What are the age of the client? What's the value of the home? How much are you advancing?
Well, I think Craig mentioned that earlier.
Yeah, there's
The average age of the homeowner is mid-50s. The average home value is $2 million, and the average chief is about $350. I think more importantly, Don, I think that question may revolve around our minimums. I mean, the minimum home value is probably 450-ish. Our guidelines state $70,000 is the minimum chief. So that's the minimum.
All
And
right.
what was not disclosed is if there's an existing mortgage and it's a small mortgage, that we can go behind that mortgage. You don't have to pay it off. That's a 2% cost of funds, there's no reason to pay that off.
That's right.
We could
That's
do
right.
a chief on top of that.
Which is great because a lot of people with a $1.5 million home, they have $100,000, $150,000 mortgage at 2.75%. Just leave it there. It's fine.
Leave it.
Question from Tony Saris. Is the amount a client can receive from Chiefs, the 20, 22%, the same regardless of the client's age? If there is a mortgage, is the estimated amount, the 20, 22% based on the net equity in the home?
So Don, the answer to the first question is there is no difference between someone being 50 versus 60 versus 70 years of age.
Right.
The amount of money that they're entitled to is the same. Chris mentioned before, as he was going through the spreadsheets, there was this 50% combined loan to value. The way that works in practice is if an individual has $1 million house with a $100,000 existing mortgage, they have a 10% loan to value. The most that we would take is up to a 40% equity share. And based on a max 40% equity share, thank you very much, Chris, for doing that. The amount of money that we might be able to give someone is roughly about 15% on day one.
Got it. Just looking at.
Craig, I got a quick question. How
Go ahead.
much mortgage is too much? If somebody has $1 million home, but they got a $500,000 outstanding loan, is Chiefs an option?
Yeah, it's a great question, Chris. So if someone has a mortgage that's greater than 50% of the value of the property, probably not the right customer for Cornerstone. If it's less than 50%, it's very doable. But I think the sweet spot for most of the audience's customers is mortgages that are less than a third of the value of the property. Call it 30 to 35% of the value of the property and less. Now you're talking about being able to access a relatively reasonable amount of home equity.
And Craig, somebody 95 could do this, right? It wouldn't matter.
It would not matter.
That's amazing.
Yeah, and obviously this would not be a good option for a 95-year because it's unlikely they're going to be here 10 years from now, right? Even though they could do it, it would do, I don't think it would make sense unless, they're going to live, they know they're going to live until they're 130. Or 100, I shouldn't say 150, 120. But kind of an overriding question, what next? So for any of you that have interest in this program, you certainly can reach out to InsMark, contact Julie Nayeri, and she can put you in touch with the Cornerstone people as far as how you work with them. And I'm not saying. Oh, okay. Here's a question. No, I think that's pretty much all the questions I had, and that were posted. Craig or Dan or Chris, any final comments or additional questions you wanted to cover?
Yeah, why don't I go first? Again, alphabetical order. What was not mentioned, we're approved in 20 states and growing. So
Good.
those 20 states are on our website, chiefs.com. And again, we spell Chiefs the right way, Cheifs, also known for converting home equity into financial success.
Don, I have no further comments. I mean, I know I speak on behalf of everybody at Cornerstone, and certainly Dan and I. We really welcome the relationship with you and Dave and everyone over at InsMark. Chris, the same holds true for you and Bob over at NextPoint. We think it's wonderful when you can give advisors the opportunity to better serve their customers. And given how significant home equity is relative to someone's entire balance sheet, we think this is a very efficient way for homeowners and their advisors to potentially access home equity. And ultimately, Don, what we like about InsMark, you said it, but it's worth saying again, by showing status quo versus Chiefs, status quo versus other types of scenarios, you're really giving advisors and their clients the ability to compare and contrast multiple solutions. And I think that's what we're supposed to be in the business of doing.
And
Yeah,
we as
and if you can show that by repositioning Chiefs into disability income policy or alert or mutual fund or whatever financial product you're showing or featuring for that particular client and their suitability, you can really show the impact short, medium, and long term to their liquidity and net worth. And there's really no closing process. This is where you are now. This is significantly better. Should we move forward? I love that aspect.
But you
guys,
also, Don, the
it's financial.
module also addresses suitability and best interest by purely the compare and contrast. And Chris, I see something up on your screen. It's actually primechiefs.com is
Oh,
the
sorry.
current version.
Yeah, that was the first one.
Yeah.
This one.
Go ahead,
Yeah.
Chris. I interrupted you. Sorry.
No. I was just going to say, we as financial advisors, and just to make clear, by the way, I don't work for InsMark. I don't work for Chiefs. I'm an independent fiduciary. But our job as financial advisors, really, yes, the planning, but finding the money so that it kind of becomes cash flow and balance sheet neutral to the client. What other program can you find the money for somebody that's a dormant asset and monetize that and give them that discrepancy in liquid assets and or income derived down the road than this one? I've never seen anything like it. So find the money. Chiefs helps find the money.
Yeah,
Great.
one last question, and I know the answer, but I'd like Dan or Craig to answer this. It says can hotel owners do this on their hotel properties?
No. Craig said earlier, owner occupied only. First, second, third, fourth, fifth home. Craig did mention no rental. We do have one small caveat, rental up to 60 days. That's it. So a second home, if you rent it for a month, that's okay. We can participate.
Okay. Well, thanks everyone who attended today. We really are excited about this, and we'll keep working to get you as much information as we can and keep you informed. and you'll be seeing future webinars that will be showing the repositioning of the Chiefs funding into other financial products like a long-term care product and so on. And Chris, thank you so much. Do you have any final comments?
Um, as I said, I like to say I started using InsMark before I got married, before I became a father, and before I became a grandfather. So I've been doing this thing now for let's see, I've been in the financial services industry 41 years and using InsMark for 38 of those. And far and away, this is the most exciting thing I've seen happen in the industry and within the capability of InsMark to demonstrate the status quo versus the do it, don't do it. It's just absolutely fabulous. And just looking forward to opportunity of working with people if they would like to. But again, Craig and Dan and Don, thanks for making the marriage of Chiefs and InsMark. It's just absolutely sensational.
When I saw the structure and the long-term APR and the correlation between older clients in their forever homes, relatively healthy, one or two of the spouses, and the ability to create liquidity, and the cost of that cost in quotes would be possibly a slightly lower estate, maybe not, but creating all that additional liquidity. I kind of stopped all the presses at InsMark. I said, we have to create this now. And so
And you
that was
did.
about 2 months ago.
And you did. Thank you, InsMark team, for seizing an opportunity.
Yeah,
Yeah,
I
by
think
the
it's
way, special thanks to Richard, the programmer, because I've kind of been test driving this thing and I'll send something to him at night. It's like, this isn't working, or can we add this? And the very next day, it's fixed or added. He's amazing. The whole team.
so thank you, everybody. Thank you, all the hosts, and have a great weekend, everybody.
Thanks, guys.
Thank you, everybody.